Dustin Tibbetts here, financial advisor with Jazz Wealth Managers, and we have a request. We actually have a video. Someone requested that we do the tax differences between a 401k and a Roth 401k, and it's not as obvious as you think, so there's two things I want you to keep in mind. Okay, three. I want you to first keep in mind if you have an old 401k or Roth 401k from an old employer, I hope you'll consider us here at Jazz Wealth. We'll help you roll that over. There's never a charge for that. We'll get you all set up, and we'll help you with your personal finances as well. We're trying to work with the little guy, the people that are just getting started, that have the old 401ks and they want the help and advice, but those guys in the suit and ties and big buildings won't talk to you because you're not a millionaire. All right, well, that's enough of pitching Jazz Wealth. Just be sure to check us out. If you do a quick Google search about 401ks and Roth 401ks, you may think, and here's where there's a big trip up here, you might think that, well, money that goes into a 401k is tax deferred, meaning you'll pay the tax in retirement, and money that goes into a Roth 401k is all post-tax. Well, you'd actually be mistaken there. There's a little sort of hitch in our get along that we need to talk about. So here's the thing, when you contribute to a 401k, you do it only to the match. I always say that. You put the match in, or whatever you have to do to get the match, and not a penny more. So you put in $1, your employer puts in 50 cents or something up to some amount. That is all pre-tax money in a 401k. When you go to take the money out from retirement, both the employers match whatever they put in, and whatever you put in will be taxed in retirement. Now, in a Roth 401k, you're putting money in after tax. So you've already paid the tax on your contributions, but your employer is putting in money pre-tax. So it looks like this. You have your paycheck, and before your paycheck gets taxed, your employer takes some money out and they put it into your 401k or your Roth 401k. Then you pay all the taxes, and at the very end, after you've paid the taxes, now your contribution goes into your Roth 401k. So there's a difference there, and that's a big deal, right? That's something that you need to know, is that the Roth portion of a 401k, your money, post-tax. Whatever the employer puts in, you still have to pay tax on that in retirement. Now, you ready for the trick of the day? If you have a Roth 401k and you put money in, your employer puts some money in, and something's come up, you need to take money out early. You might think, well, it's a Roth, so I can take my contributions out and not pay any penalties or taxes, right? Well, again, you'd be wrong. Google search would actually probably not help you in this case. You'd be getting misleading information. Here's how it works. In a Roth 401k, when you put your money in, yes, it's post-tax. When your employer puts the money in, it's pre-tax. When you take the money out early, you're not allowed to specify which portion of your account you want to take out. See, you might say, well, I just want to take out some of my contributions. But the IRS code says we mix it all together. You take some of your contributions and some of what your employers put in, which remember, you haven't paid tax on yet. So how it works is when you take an early withdrawal from a Roth 401k, 20% gets withheld right off the top, and then you pay the 10% penalty. So don't fall into that trap. It is not like a Roth IRA, but I have another trick for you. So here's the trick. If you have a Roth 401k, roll it over to a Roth IRA. The rules are completely different for a Roth IRA as it pertains to the IRS. In a Roth IRA, when you take money out early, you're able to specify, are you taking out growth or are you taking out contributions? In other words, pre-tax or post-tax. And you can actually say, I only want to take out my contributions, therefore no tax, therefore no penalty. So that's a little trick. If you can roll it over first, then take the money out early, if you have to take it out early, then do it that way. Here's a bonus tip that may get you to hit the subscribe button, which we would greatly appreciate. In a Roth IRA, there's an income limit. If you make too much, you can't contribute for the year that you made too much. Now, if you're married, filing jointly, the number is $199,000 for 2018, but that's your modified adjusted gross income. In a Roth 401k, there's no income limit. So if you think your income is going to be high and stay high, then that Roth 401k may be your best option, but I think it's something we should talk about because there are other accounts as well. It's just something you have to weigh there. Now, if you have a Roth 401k or you're thinking about starting a Roth IRA and you go, oh man, my income's too high, well, don't worry, we have a few tricks for that as well. Legal tricks, by the way. We never do anything illegal. All right, well, do me a favor, hit the subscribe button if you would, and in the meantime, here's 2 more videos you might like. This one over here is one of my favorites. Shows you how $72 a week can translate into a lot of money in retirement, so be sure to check that out.